Welcome to Wall Street Weekly.
Glad to be here for this one.
Yeah, imagine waking up on Monday morning to this historic, global economy-altering world peace.
Right.
And then by Wednesday afternoon, your portfolio is bleeding so badly, you just wish you had stayed in bed.
Yeah, it was brutal.
We're so glad to have you with us for this incredibly detailed deep dive into what was, without exaggeration, an absolute whiplash of a trading week.
Whiplash is the perfect word for it.
We are dissecting the week of June 15th to June 19th, 2026.
And, because Friday was the Juneteenth federal holiday, we are dealing with a truncated 4-day trading week.
Right, a shorter week.
But honestly, the sheer density of financial data, the geopolitical seismic shifts, and, well, the monetary policy shocks crammed into those 96 hours.
It felt like a whole fiscal quarter, didn't it?
It genuinely did. It felt like an entire quarter happened in a matter of days.
The velocity of the news cycle this week was just staggering.
We experienced massive geopolitical breakthroughs, a literal structural central banking regime change, and blockbuster corporate mega deals.
All colliding in real time.
Exactly. For institutional risk desks, this week was an absolute stress test.
The stress test of, algorithmic trading models and human nerve.
Totally.
So our mission today is to unpack all of that raw data for you.
Because if you are managing your own capital right now, you really need to understand exactly how these forces interacted.
Right. We're going to deconstruct the daily market swings, drill down into the underlying sector performances, and map out the global economic ripples.
And then we're going to strictly outline what you must monitor in the upcoming week of June 22nd to June 26th.
Because to really understand how your portfolio behaved this past week, you kind of have to visualize a massive, violent tug of war.
A tug of war is a great analogy.
On one side, you have this relentless macroeconomic gravity, sticky inflation, skyrocketing yield curves.
And a newly aggressive central bank actively trying to pull equity multiples back down to earth.
Exactly. But then on the other side, you have this incredibly potent microeconomic rocket fuel.
Right, the massive corporate innovation, strategic M&A action, and a sudden massive geopolitical relief salve trying to blast the market higher.
So when these two unstoppable forces collide on the trading floor, how does the market actually decide which way to break?
Well, that is the defining question for capital allocators this year.
Yeah.
And what we witnessed this week was the market attempting to price in both forces simultaneously.
Which is why cross-asset correlations completely broke down. Right?
Exactly, broke down entirely. To understand how the market ultimately absorbed this collision, we have to start with the rocket fuel.
The rocket fuel that ignited the tapes right at the opening bell on Monday.
Let's start with that absolute euphoria on Monday.
And it wasn't driven by an earnings beat or a sudden drop in inflation.
No, it was driven by the most immediate, tangible global relief valve imaginable.
The sudden stabilization of the Middle East.
Over the weekend, the wires just lit up with the Islamabad Memorandum of Understanding.
We saw a historic U.S.-Iran peace deal officially brokered by Pakistan.
And I want to dig into the mechanics of this because the market didn't just cheer for peace,
Right, it cheered for logistics.
Precisely. You have to look at this through the lens of maritime risk and global supply chains.
Because for months, global energy markets have been pricing in a severe structural war premium.
Yeah. Risk models were heavily weighted toward the threat that the Strait of Hormuz would remain blockaded.
Or at least highly restricted.
Right. We are talking about a vital maritime choke point that handles essentially 20% of the entire world's crude oil transit.
Not to mention a massive percentage of global liquefied natural gas.
Exactly. The insurance markets at Lloyd's of London had spiked whole risk premiums to levels that made shipping through the region economically toxic.
So expensive.
Unbearably expensive. But when Prime Minister Shehbaz Sharif brokered this deal and the ink dried on the Islamabad Memorandum,
we saw the immediate, verifiable dismantling of those naval blockades.
the maritime insurance markets collapsed their risk premiums almost instantly on Monday morning.
Right, because it wasn't just diplomatic posturing on paper. The physical logistics changed immediately.
Yeah, U.S. Vice President J.D. Vance came out and confirmed that a baseline wave of cargo transit had already cleared the waterway.
We're talking about a confirmed backlog of at least 12 major energy supertankers from Saudi Arabia and Qatar.
Finally moving through the strait safely.
When you suddenly flush millions of barrels of crude and LNG out of a logistical logjam and into the open ocean.
It's not just a supply increase, it is a frictionless delivery shock.
Wow, frictionless delivery shock. I like that.
It fundamentally rewrites the near-term supply-demand curve.
So the geopolitical war premium outright collapsed.
It vanished, and the reaction in the energy futures markets was violent.
International benchmark Brent crude tumbled 3.13% for the week,
Crucially, it sliced right through the $80 psychological and technical threshold.
which triggers those massive algorithmic sell programs.
Exactly. It eventually settled at $79.85 a barrel by Thursday.
And here is where we really have to look at the domestic picture.
Because WTI crude fell even harder.
Right, dropping 5.25% to settle at $76.51.
This sets up a really fascinating dynamic that we need to unpack. The transatlantic divergence.
Right, the Brent WTI spread.
The price delta between the international benchmark and our domestic benchmark.
It aggressively expanded this week by over $1.60.
It blew right past the $4 mark.
So wait, if global logistics clearing up was the primary catalyst, why did domestic oil get punished so much harder than international oil?
Well, it comes down to the bifurcation of supply catalysts versus demand catalysts.
Okay, break that down.
Brent crude benefited immediately from the supply-side logistics clearing up. The supertankers were moving again out of the Persian Gulf.
So international demand in Europe and Asia was suddenly being met efficiently.
Right, without rerouting ships around the Cape of Good Hope.
But domestic WTI crude suffered a localized fundamental double whammy.
First, it faced the same overarching global deflationary pressure from the peace deal.
Makes sense.
But second, it got hit with a domestic demand shock. We received a miserable U.S. housing starts report.
Plunging to a 6-year low in May.
Right. So that housing data isn't just about lumber and mortgages.
It is a direct proxy for heavy industrial inland energy demand within the United States.
Exactly. Think about the physical footprint of new housing developments.
Massive fleets of construction equipment.
Long-haul domestic trucking to move materials, paving equipment, heavy machinery.
And all of that runs on middle distillates.
Specifically, diesel derived directly from domestic WTI crude.
So when housing starts collapse to a 6-year low, the forward-looking demand profile for industrial diesel just evaporates.
So domestic oil took a disproportionately heavier hit because the market priced in both the global geopolitical relief and a localized domestic industrial slowdown.
But wait, let's play this out logically for a second.
Yeah.
If energy costs are essentially a universal global tax on logistics and production, right?
Okay.
And it suddenly gets radically cheaper to ship goods, fly passenger planes, and power factories.
It did.
Shouldn't oil plunging below $80 have sent the entire equity market into a massive multi-week bull run?
You would think so.
I mean, cheaper inputs mean wider profit margins for almost every sector. Why didn't that Monday euphoria last past the closing bell on Tuesday?
Because that is the crucial pivot point of the entire week.
Okay.
The microeconomic rocket fuel of cheap oil and geopolitical peace was spectacular for corporate margin models.
But
But on Wednesday, the market slammed face first into macroeconomic gravity. Investors realized that cheaper oil might solve the supply-side inflation problem, but it does absolutely nothing to solve the demand-side inflation problem.
the demand-side inflation that central banks are obsessed with.
Exactly. And that brings us to Wednesday.
The Federal Reserve.
The Federal Reserve.
Yeah.
Specifically, the highly anticipated June FOMC meeting.
And the official brutal debut of the Warsh era.
This was Kevin Warsh's first meeting as the newly appointed chairman.
And to be historically fair, the FOMC unanimously held the benchmark target rate at 3.50% to 3.75%.
They didn't hike rates on Wednesday?
There was no immediate change to the cost of capital. So why did the bond market treat this meeting like a systemic shock event?
Because the market doesn't trade on where rates are today.
Right?
It trades on where the terminal rate will be 12 months from now.
The dot plot.
The shock came entirely from the updated summary of economic projections, the dot plot.
Driven by that incredibly sticky May CPI print, which stubbornly held at 4.2%.
9 out of the 18 Fed policymakers forcibly flipped their projections.
Exactly half of the committee now projects at least one formal interest rate hike before the end of 2026.
So the headline is that they held rates steady.
But the undercurrent is that they effectively promised the tightening cycle is not over.
And Kevin Warsh's debut press conference, I mean, we have to talk about his tone.
This wasn't just a slight hawkish tilt.
No, this was a massive structural regime change in how the Federal Reserve communicates with the market.
It was a violent paradigm shift.
For over a decade, going back to the Bernanke, Yellen, and Powell eras, Wall Street has been coddled by forward guidance.
Central bankers would telegraph their moves months in advance.
They would use speeches, carefully leaked journal articles, and press conferences to massage the market's expectations.
Explicitly trying to prevent any sudden shocks to financial conditions.
And Kevin Warsh stepped up to the podium on Wednesday and completely incinerated that playbook.
He drastically shortened the official FOMC policy statement.
He explicitly told institutional Wall Street that they must organically adjust to raw incoming macroeconomic data,
rather than expecting the central bank to pre-announce policy adjustment.
Exactly.
It's exactly like a driving instructor suddenly ripping the steering wheel away from a student driver while doing 70 on the highway.
That's a great way to put it.
You're just sitting there, completely unassisted, and the instructor says, "Figure it out. Watch the road."
The market was suddenly forced to navigate this threat of higher for longer rates with absolutely zero handholding from the institution that controls the money supply.
That analogy perfectly captures the sheer panic on institutional fixed income desks on Wednesday afternoon.
And Warsh had the fundamental economic cover to execute this pivot.
Right. Late in the week, initial jobless claims dropped to an incredibly tight 226,000.
That proves the domestic labor market is still exceptionally resilient.
It gave Warsh the exact macroeconomic ammunition he needed to maintain a highly restrictive, hawkish posture.
Without the political fear of immediately crashing the employment sector.
And the reaction to the fixed income markets, I mean, you look at the charts from Wednesday afternoon,
Okay.
and carnage feels like an understatement.
The repricing was violent. Fixed income desks had to aggressively re-underwrite their duration models in real time.
The two-year Treasury yield, which is hypersensitive to near-term monetary policy expectations, surged by an astonishing 2.83% to finish near 4.18%.
And the 10-year yield climbed to 4.49%.
So let's look at the relationship between those two numbers. The 10-2 yield spread experienced a massive contraction.
It crashed by 32.84%.
Dropping down to a microscopic 0.272%.
This is the yield curve aggressively flattening.
For you managing a portfolio, we really need to explain the exact mechanics of why a hawkish Fed triggers this specific phenomena.
Let's break down the mechanics of the bear flattener.
Okay.
When the Fed signals they're going to hike rates in the near term or hold them higher than previously priced, the short end of the curve, the two-year yield, spikes incredibly fast.
Because its valuation is directly mathematically tethered to the federal funds rate.
Right. However, the 10-year yield, while it also goes up, rises at a much slower velocity.
Why is that?
Because the bond market knows that aggressive near-term rate hikes will eventually choke off long-term economic growth and aggravate demand.
So long-term inflation expectations actually drop because the Fed is applying the brakes so hard.
Therefore, the gap between the fast-rising 2-year and the slower-rising 10-year rapidly shrinks.
A spread contracting down to 0.272% shows a bond market bracing for a severe, prolonged squeeze on corporate margins and economic expansion.
It's a very clear warning signal.
So we have the interest rate shock clearly established. Now we need to look at how different tiers of the equity market actually absorbed or failed to absorb that macroeconomic blow.
Over the truncated 4-day week, the S&P 500 fell 0.71%, and the Nasdaq dropped 0.62%.
But if you look at the Dow Jones Industrial Average, it showed incredible resilience.
It only dropped 0.21% for the week.
And actually hit an all-time record high of 51,909.67 during Tuesday's session before the Fed meeting.
The Dow's relative outperformance is a textbook example of a flight to defensive value in a high-rate environment.
Because when the cost of capital spikes, institutional investors rotate out of high-duration growth companies.
Those tech companies whose cash flows are years in the future.
And they hide in massive cash-generating blue chips.
The companies in the Dow generally have bulletproof balance sheets. They don't need to tap the debt markets to fund their operations.
So they're insulated from the immediate pain of a 4.18% two-year yield.
Exactly. But to truly measure the localized damage of Kevin Warsh's pivot, you have to look down the capitalization ladder.
We have to look across the Russell spectrum.
Let's unpack the pain hitting smaller companies.
The large-cap Russell 1000 dropped only 0.40%.
Because, similar to the Dow, the Russell 1000 constituents are insulated by sheer scale.
These mega caps often have massive cash reserves.
In a higher-for-longer regime, they can actually deploy their treasury departments to buy these higher-yielding government bonds.
Wow, so they transform a macroeconomic headwind into a financial tailwind.
By generating substantial interest income on their own balance sheets.
Then you step down to the Russell Midcap, which took a heavier hit, dropping 0.94%.
The midcaps were severely pinched by that May U.S. housing starts data we discussed earlier.
A 6-year low in building permits crushes the forward earnings multiples for mid-cap industrials, materials companies, and regional construction suppliers that populate that index.
They lack the global diversification of the megacaps.
So when U.S. domestic housing stalls, their revenues take a direct, unhedged hit.
And then we reach the bottom of the ladder, the Russell 2000.
The small caps. They took the heaviest absolute damage, dropping a full 1.00% over the 4 days.
You have to ask, why is the small cap sector so uniquely, structurally vulnerable to this specific central bank environment?
It all comes down to the underlying architecture of their corporate debt.
Right. Large companies have the luxury of issuing fixed-rate corporate bonds.
They went into the capital markets years ago when rates were at zero and locked in incredibly cheap debt for 10 or 20 years.
Small cap companies, however, don't have that kind of access to the bond market.
They rely heavily on syndicated bank loans and floating rate debt structures, often tied to SOFR.
The secured overnight financing rate.
Right. When the Fed's dot plot flips hawkish and that 2-year yield spikes, the interest expense on floating rate debt resets higher almost immediately.
The cost of servicing their debt literally increases overnight.
They are incredibly sensitive to Warsh's hawkish shift, because every basis point the Fed adds directly and immediately vaporizes their free cash flow.
But even in this brutal high-rate environment for smaller companies, we saw isolated pockets of absolute buoyancy this week.
Primarily driven by corporate megadeals.
Yeah. On Monday, amidst the geopolitical relief rally, we saw Fox announce a $22 billion acquisition of Roku.
And the market mechanics of how those two stocks reacted is a perfect textbook example of M&A arbitrage in a restrictive rate environment.
Roku's equity surged significantly because Fox is paying a massive control premium to acquire their operating system.
Their advertising distribution channel and access to their 100 million global households.
But Fox shares plummeted nearly 17% on the announcement.
Because Fox is the entity footing the $22 billion bill when the cost of capital is punishingly high.
The market looked at that deal and immediately punished Fox for the massive capital layout.
The debt they will likely have to issue to fund it, and the complex integration risks involved.
Now, speaking of complex equity mechanics that affect the small cap space, we have to look under the hood at a massive structural event happening this week.
The FTSE Russell semi-annual rebalancing.
Right.
If the macro environment is so terrible for small caps right now, how does this forced institutional repositioning provide a liquidity cushion for these battered Russell 2000 names?
This is a vital technical market structure point that often gets ignored by retail investors.
Okay, lay it out for us.
When the Russell indexes rebalance, which they are now doing semi-annually in 2026, they recalculate the market capitalization of every eligible U.S. stock to determine who moves up to the Russell 1000, who drops down to the 2000, and what their exact weighting in the index will be.
Every passive index fund, ETF, and institutional mandate that tracks these benchmarks is legally forced to buy or sell shares to exactly match the new index weights by Friday's close.
If a small cap company performed relatively well over the last 6 months and increased its weight within the Russell 2000, billions of dollars of passive capital must blindly buy that stock.
They don't care about Kevin Warsh, they don't care about the dot plot, and they don't care about floating rate debt.
Exactly. This forced institutional buying creates a massive wave of technical volume,
providing a structural liquidity cushion that prevents the entire small cap sector from completely bottoming out during macroeconomic panics.
So we have small caps struggling under floating rate debt. The broader market is reeling from the Fed pulling the steering wheel away on Wednesday.
It feels like the oxygen is being sucked out of the room.
But then, Thursday morning arrives, and we get a massive microeconomic shock event that practically saved the entire tech sector from a disastrous week-through close.
We did. Just as the Nasdaq was looking incredibly technically vulnerable, threatening to break key moving averages, we got a blockbuster semiconductor announcement that completely changed the narrative.
President Donald Trump revealed on social media that Intel has officially partnered with Apple to design and produce custom silicon chips exclusively inside domestic U.S. fabrication plants.
This was a monumental shift.
Yeah.
Think about the context. We were just analyzing reports a few weeks ago about Apple warning that global memory component shortages and Asian supply chain bottlenecks would make hardware price increases unavoidable.
And suddenly, out of nowhere, this massive domestically secured supply chain rescue operation is announced.
The reaction across the semiconductor space was explosive.
Intel skyrocketed 10.6%.
Micron surged 8.7%, and NVIDIA climbed 3.0%.
It completely erased the steep, rate-driven losses the Nasdaq had suffered on Wednesday.
And you really have to understand the mechanics of the short-covering surge that this announcement triggered.
Prior to this news, Intel was viewed as a legacy player struggling to compete with TSMC's advanced nodes.
Many institutional hedge funds had heavily shorted Intel stock, betting its price would continue to decline.
When you short a stock, you borrow shares and sell them, hoping to buy them back cheaper later.
But when this massively positive, unexpected news broke, the stock price spiked instantly.
Those short sellers suddenly faced massive unrealized losses and margin calls.
It's exactly like someone yelling "fire" in a crowded theater, but instead of running for the exit doors, every short seller had to sprint to the box office to buy a ticket at whatever exorbitant price the scalpers demanded, just so they could be allowed to leave.
That's a vivid image, but perfectly accurate. They had to execute market buy orders to cover their borrowed shares.
And that forced, panicked buying creates a violent feedback loop, driving the stock price up even faster and harder than a normal, fundamentally driven rally.
Exactly. It's a localized liquidity squeeze.
And because Intel, Apple, and Micron carry such immense weighting within the cap-weighted indexes, their explosive upside dragged the entire Nasdaq out of the red.
So what does all of this macro and micro whiplash mean for the broader sectors?
Let's walk through the 11 GICS sectors for the week, because the divergence between the winners and losers paints a very clear picture of what the market values right now.
Starting with the winners, industrials, the XLI, were the absolute top performer, up 1.25%.
And that outperformance ties perfectly back to our first topic.
The Islamabad Memorandum and the reopening of the Persian Gulf.
Industrials capitalized directly on plummeting logistics and fuel costs.
When the price of jet fuel and maritime diesel collapses, major airlines, airspace manufacturers, and global freight logistics companies see immediate, massive margin expansion.
Their largest variable operating costs just drop significantly, so their forward earnings estimates immediately get revised upwards.
Utilities, the XLU, also managed to stay essentially flat to positive, which is incredibly counterintuitive.
It is exceptionally rare behavior. Historically, utilities are a defensive, dividend-paying sector that acts as a bond proxy.
When Treasury yields spike to 4.18%, the yield on utility stocks becomes less attractive, and the sector usually gets crushed.
However, they are currently acting as a unique secular growth hedge because of the artificial intelligence data center buildout.
Those advanced chips from Intel and NVIDIA require immense, unrelenting amounts of electricity.
The market is pricing in the reality that regardless of what the Fed does, these utility companies have guaranteed escalating baseload power demand from AI hyperscalers.
That is fascinating, a traditional defensive sector morphing into an AI infrastructure play.
Now for the losers. Real estate, the XLRE, plunged 2.51%.
Real estate faced the perfect storm of macroeconomic gravity.
You take that 6-year low in housing starts, which shows a collapse in residential momentum, and you combine it with the 2-year Treasury yield spiking.
Higher borrowing costs immediately translate to more expensive mortgage rates, which freezes consumer residential demand.
On the commercial side, it makes refinancing commercial real estate debt incredibly toxic.
Cap rates have to adjust upward to match Treasury yields, which inherently means the underlying property valuations must mathematically fall.
And finally, energy, the XLE, dropped 3.20%.
Exactly as the crude futures telegraphed.
The geopolitical war premium vanished, the supply chains unclogged, and the sector's forward profit margins compressed as the commodity price fell.
It really feels like that Intel and Apple deal was a microeconomic defibrillator for the Nasdaq.
Just as the market was flatlining from the Fed's interest rate hike threats, this massive injection of domestic manufacturing news jolted growth multiples back to life.
But I want to zoom out from the specific sectors now.
To really understand the anatomy of this week, we need to look at how this whiplash impacted global fear gauges, raw materials, and international central banks.
Let's dissect the volatility story, starting with the VIX.
The VIX is often called the market's fear gauge, but mechanically, it measures the 30-day expected volatility of the S&P 500 derived from the pricing of out-of-the-money call and put options.
This week, the VIX executed a flawless, mathematically pure inverse dance with the S&P.
On Wednesday, when Kevin Warsh dropped that hawkish dot plot bomb, the S&P sank.
Institutional portfolio managers immediately rushed to buy S&P 500 put options to hedge their massive long portfolios against a potential prolonged sell-off.
And when everyone rushes to buy put options at the same time, the market makers who sell those options hike the premiums to compensate for the risk they are taking on.
That spike in option premiums mathematically drives the VIX higher.
So we saw the VIX spike sharply to 18.4 on Wednesday.
Correct. But then Thursday happens.
The Intel onshore manufacturing news hits the wires, the semiconductor complex squeezes higher, and the broader S&P 500 finally rebounds.
Those same portfolio managers who bought puts on Wednesday realize the market isn't crashing, so the frantic bid for downside protection evaporates.
The options premiums collapse, and the VIX gets completely crushed back down to 16.40.
The institutional fear evaporated almost instantly on the back of microeconomic news.
But if you look at the MOVE index, which is essentially the VIX for the bond market, the story is distinctly different.
The MOVE index measures Treasury yield volatility.
It surged aggressively on the war shock on Wednesday, but it contracted very, very quickly. It didn't need a Thursday catalyst to calm down.
And that divergence illustrates the fundamental difference between equity traders and bond traders.
Equity markets trade heavily on momentum, sentiment, and the narrative of corporate headlines.
Fixed income desks deal exclusively in cold, hard, algorithmic math.
Once Warsh laid out the new higher-for-longer reality and removed forward guidance, the bond market violently and efficiently repriced the entire yield curve in a matter of hours.
They calculated the new terminal rate, adjusted their duration models, and once that new baseline was established, the volatility immediately receded.
They accepted the new reality without lingering panic.
We also saw this rapid whiplash play out in long-term equity valuations.
If you look at the Shiller P/E ratio, which adjusts earnings for inflation over a 10-year cycle, we saw rapid multiple compression on Wednesday.
Investors were aggressively stripping the premium pricing off growth stocks because the discount rate went up.
But that was immediately followed by multiple expansion on Thursday when the semiconductor rally restored confidence in future cash flows.
It highlights how hypersensitive equity valuations are right now.
The market is balanced on a razor's edge between the rising cost of capital and the promise of exponential future earnings growth from technology.
Any slight breeze from either direction causes violent re-rating.
While equities and bonds were fighting over interest rates, there was an entirely different asset class, completely ignoring the Federal Reserve and trading strictly on its own physical fundamentals.
Let's look at broad commodities.
The BCM index was down 1.20% for the week.
We know energy was down 2.37% due to the peace deal.
We know precious metals were down 2.79%, which is entirely logical because high interest rates trigger gold liquidations.
Gold yields 0%, so why hold it when you can get a risk-free 4.18% on a 2-year treasury?
But amidst all this macro-driven selling, agriculture, the SPGS Ag Index, actually surged 1.46%.
Why is agriculture completely decoupled from everything else?
Because you can't eat a treasury bond, and corn doesn't care about Kevin Warsh's dot plot.
Agriculture completely decoupled from energy deflation and the strength of the U.S. dollar because it is currently trading entirely on shifting weather risk premiums and physical supply disruptions.
The grain and soft commodity futures markets are looking at mounting verifiable supply constraints in key global growing regions.
Commercial grain desks were aggressively reallocating capital into ag products, essentially betting that baseline domestic consumer spending on food remains highly inelastic regardless of how high interest rates go.
If there's a drought, the price of wheat goes up, period.
We saw a similar dynamic with Henry Hub natural gas, which jumped 1.59% this week.
Right. Despite the broader energy complex falling due to the Middle East peace deal, natural gas is a highly localized, landlocked commodity.
We saw meteorological models forecasting unseasonably high, anomalous summer temperatures across major U.S. metropolitan corridors.
That means a massive projected spike in power burn requirements.
Utility companies have to aggressively burn natural gas to generate the electricity required to keep up with peak air conditioning demand.
It is pure physical supply and demand overpowering macroeconomic sentiment.
Now, speaking of macroeconomic shocks, we have focused heavily on the U.S. Federal Reserve, but we absolutely have to talk about the international shockwave that hit the currency markets on Tuesday.
The Bank of Japan.
The BOJ raised their benchmark interest rate to a three-decade high of 1%.
For anyone under the age of 40 working in finance, this is unprecedented.
This is a seismic structural shift for the global financial plumbing.
Japan has been the anchor of negative interest rates for an entire generation.
And BOJ Deputy Governor Ryozo Himino issued a really stark warning to accompany this hike.
He explicitly stated that moving too slowly on inflation is a far greater systemic danger than moving too quickly and dampening growth.
That rhetoric is incredibly aggressive for the traditionally dovish BOJ.
They are officially abandoning decades of yield curve control.
And this monetary tightening triggered intense currency volatility. The Japanese yen plummeted to a two-year low against the U.S. dollar.
When a country's currency drops that fast, its massive export companies, automakers, electronics manufacturers suddenly become much more profitable on paper because their foreign earnings translate back into more yen.
That currency devaluation pushed the Nikkei 225 index to briefly breach the historic 70,000 milestone.
But this BOJ move raises a massive systemic question for anyone managing global capital.
If the European Central Bank hiked rates last week, and the Bank of Japan just hiked to a 30-year high this week, and the U.S. Federal Reserve is actively threatening to hike later this year,
are we witnessing a coordinated, synchronized global end to the easy money era?
Undoubtedly, we are observing a fundamental structural realignment of global capital.
For over 15 years, the global economy has been deeply addicted to zero interest rate policies and quantitative easing.
Central banks worldwide are now globally synchronized in their effort to proactively crush underlying structural inflation, even if it means deliberately engineering mild economic recessions.
The era of free, frictionless capital is officially over, and the repatriation of capital, especially Japanese capital returning home to newly positive yields, will have profound ripple effects on global bond liquidity.
So, with all of that monumental data digested and the Friday, Juneteenth closure behind us, we need to strictly outline the road ahead.
If you are preparing your portfolio for Monday morning, what are the exact metrics, macro reports, and corporate earnings that will drive the market when physical trading floors reopen for the week of June 22nd to June 26th?
The focus shifts immediately back to navigating central bank communication and determining whether corporate earnings can actually withstand this new, higher-for-longer rate environment without margins collapsing.
On Monday, June 22nd, before the market even fully settles into the week, we have Fed Governor Christopher Waller speaking publicly.
And institutional trading desks are absolutely desperate to parse his language.
They are treating this speech as a crucial, real-time litmus test.
Everyone wants to know if Waller will echo Chairman Warsh's harsh, data-dependent higher-for-longer stance, or if he will act as a stabilizing voice and offer any nuanced guidance, perhaps hinting at a specific timeline for that projected late 2026 tightening.
If Waller leans aggressively hawkish and reinforces Warsh's tone, expect bond yields to spike again immediately, putting immense pressure back on the Nasdaq and small caps.
Then we get into the heavyweight corporate earnings, which serve as the real-world lie detector test for the macro data. Tuesday, we have FedEx reporting.
FedEx is the ultimate diagnostic check on global commerce and supply chain health.
We just had peace declared in the Middle East and shipping lanes unclogged. Analysts are going to brutally dissect FedEx's forward guidance.
They will be looking at the yield per package and fuel surcharge revenues to see if the drop in international jet fuel and maritime logistics costs is already showing up in their operating margins.
Furthermore, a breakdown between their B2B express shipping versus B2C ground shipping will tell us exactly how healthy aggregate consumer demand really is.
Also on Tuesday, we hear from Carnival Corporation.
Carnival is going to answer the consumer health question from an entirely different angle.
This is a pure check on premium leisure demand running headfirst into high interest rates.
Analysts will be scrutinizing their customer deposit metrics, which essentially act as interest-free loans from consumers and forward booking curves.
Are middle-class consumers still willing to book expensive discretionary cruises despite credit card rates hovering near record highs?
Or are we seeing increased cancellation rates and aggressive discounting to fill cabins? Carnival's massive floating rate corporate debt load also makes them highly sensitive to the Fed's recent hawkishness.
Wednesday brings massive implications for the tech sector, Micron Technology reports, and Wall Street is currently modeling triple-digit growth.
Micron is the undisputed bellwether for the physical artificial intelligence hardware cycle.
After the euphoria of the Intel-Apple onshoring news, the market desperately needs Micron's forward guidance on high bandwidth memory, HBM, pricing.
They need to validate if the immense capital expenditure by hyperscalers on AI hardware is truly functionally insulated from the Fed's tightening path.
If Micron signals any weakness in pricing power or warns of supply glut, the entire semiconductor sector could see rapid, violent, multiple compression.
Also on Wednesday, we get a direct look at the housing market with KB Home reporting.
We just saw a disastrous 6-year low in housing starts. Equity strategists will parse KB Home's report not for their current deliveries, but for their forward-looking metrics.
Gross margins, cancellation rates, and specifically how much capital they are burning on mortgage rate buydowns to incentivize buyers.
We need to see exactly how much fundamental damage 4.5% mortgage rates are inflicting on homebuilder profitability.
Thursday brings McCormick & Company,
the spice maker. This might sound mundane compared to AI chips, but it is a critical pure-play check on grocery input inflation and consumer elasticity.
Analysts will look at volume versus pricing mix. Are consumers still willing to pay premium prices for branded spices? Or is McCormick seeing a massive consumer trade down toward cheaper, private label store brands?
That single dynamic tells us how fundamentally stretched the average consumer's wallet really is at the grocery store.
And running parallel to those earnings, the macroeconomic data docket is incredibly heavy. Tuesday brings the S&P Global Services and Manufacturing PMIs.
These are the flash readings for June. We need to look deeply into the new order subcomponents to see if manufacturing momentum is accelerating now that the Persian Gulf is open and crude oil prices have stabilized lower.
Remember, a reading above 50 indicates expansion. Anything below signals contraction.
Wednesday gives us new home sales for May to corroborate the housing starts data alongside crude oil inventories. But Thursday is really the apex of the week, isn't it?
Thursday is the most critical macroeconomic day of the month. We get the core PCE price index for May,
which crucially is the Federal Reserve's preferred gauge of inflation.
Exactly. Unlike CPI, core PCE strips out volatile food and energy components, and it accounts for the substitution effect when consumers change their buying habits due to price hikes.
If core PCE, particularly the supercore services component, shows any sign of stickiness or upward momentum, it immediately mathematically validates Kevin Warsh's hawkish posturing from Wednesday.
It will force the bond market to price in that projected rate hike with near absolute certainty.
We also get the final revision for Q1 GDP, durable goods orders, and the weekly initial jobless claims on Thursday.
It is a massive, highly consequential data dump that will largely dictate the equity market's trajectory heading into July.
And as a structural market note, we have to remember that on Monday morning, right at the opening bell, we are going to see heavy block trading volume and elevated volatility.
The Russell reconstitution is finalized and goes into effect, but also the Nasdaq 100 special rebalance takes effect. High-growth names like CoreWeave, Astra Labs, and Rocket Lab are officially joining the index.
Which means passive index managers and ETFs have a strict legal mandate to execute massive buy orders for those specific names the exact second the market opens, regardless of price.
The technical friction and bid-ask spreads will be intense for the first 30 minutes of trading.
We have covered an unbelievable amount of structural, macroeconomic, and fundamental ground today.
It was a very full week.
To wrap up this deep dive, what is the one forward-looking thought you want the listener to take away and mull over as they prepare for the week ahead?
Well, if we connect the end of the easy money era to the broader geopolitical picture, the thought experiment I want you to consider is this.
Okay, let's hear it.
If central banks, the BOJ, the ECB, the Fed, are globally synchronized in their mandate to kill inflation by aggressively raising rates and shrinking their balance sheets, the next systemic casualty might not be corporate equities or small cap margins.
What could it be?
The next casualty could be sovereign debt itself. For the last 15 years, central banks have been the guaranteed buyer of last resort for government bonds.
Right.
If the Bank of Japan stops buying Japanese government bonds and the Fed stops buying U.S. treasuries, who steps in to absorb the massive multi-trillion-dollar supply of new sovereign debt issued to fund government deficits?
That's a huge question.
The market is pricing in corporate risk perfectly, but I don't think it has fully priced in the liquidity risk of a world where governments have to compete with corporations for scarce, expensive capital.
Especially with Kevin Warsh eliminating forward guidance, institutional risk desks are flying blind.
So the question you have to ask yourself as you review your portfolio is, are your assets prepared to navigate an environment where the central bank outright refuses to hold your hand and capital is no longer free?
If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or a review wherever you listen to your podcast, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.